Imagine a janitor outperforming a Harvard surgeon in the operating room. Imagine someone who has never touched an engineering textbook designing a skyscraper more resilient than anything Bechtel has ever built. You'd call it fiction, a bad movie premise, an insult to expertise itself, but in the world of money, this exact scenario happens every single day, and most people never even notice it because the story doesn't make headlines. It makes obituaries. Ronald Redd died in 2014. He spent his entire working life fixing cars at a gas station and sweeping floors at a J.C. Penney. Nobody knew his name. He drove a used car, wore a second-hand coat, and split his own firewood to keep the heating bill down. When he died, he left behind an estate worth $8 million. He donated 6 of it to a local hospital and library. Now take Richard Foscone, Harvard MBA, vice chairman of a major financial institution, a man who managed billions, who sat in boardrooms where the word risk had a mathematical definition and a dedicated team to calculate it. In 2008, he went completely bankrupt. His Connecticut mansion, valued at $9 million, was eventually foreclosed. Same era, same economy, same crisis. Completely opposite outcomes. This is the core truth of how wealth actually works. What makes this perspective so quietly revolutionary is that it doesn't try to explain financial success with complex equations, market charts, or portfolio theory. It explains it through human nature, through stories, through the uncomfortable observation that the real rules governing money are almost entirely invisible, not because they're hidden from us, but because they live deep inside our own psychology. That's not a fluke. That is the foundational truth of your financial life, and it's one that almost nobody talks about with the seriousness it deserves. Doing well with money has almost nothing to do with how smart you are. It has everything to do with how you behave. We have been conditioned to treat finance like a hard science, like physics, like chemistry. We believe that if we get the formula right, the right asset allocation, the right PE ratio, the right macroeconomic call, we win. But finance is not physics. It's psychology wearing a suit. Your IQ is largely irrelevant. Your emotional wiring, your personal history, the invisible script your childhood handed you about what money means and what danger feels like. That is what determines whether you retire wealthy or spend your final years anxious and underfunded. And right now, in 2026, this matters more than it ever has because we are drowning in financial data, real-time markets, analyst reports, algorithmic trading signals, Reddit threads, podcasts, TikTok finance influencers, more information than any previous generation could have imagined. And yet we remain captive to the same ancient wiring that once helped us survive on the savannah. More information has not made us more rational. It has made us more confident in our irrationality. Here is why. We experience, at most, a vanishingly small fraction of everything that actually happens in the world. Researchers estimate something like 0.0000001%, and yet, that tiny sliver of personal experience accounts for roughly 80% of how we believe the world works. If you grew up in a household where money was always scarce, your brain's threat detection system, the amygdala, is wired differently than someone who grew up in comfort. You don't just see different bank account numbers. You see a different reality. You interpret risk differently. You respond to market crashes differently. You make entirely different decisions, and from the inside, every single one of them feels completely rational. A generation that lived through the Great Depression believed in hiding cash under mattresses for the rest of their lives. A generation that watched hyperinflation turn savings to ash-believed bonds were a slow-motion trap. Neither group was wrong about their experience. They were just making the mistake of assuming their experience was universal. When people sit around a table to discuss money, they are not looking at the same spreadsheet. They are looking through the lens of their own emotional history, their trauma, their pride, their fear. That's why two people can look at the same market chart and reach opposite conclusions with complete sincerity. Now let's take that to its logical extreme because it gets uncomfortable quickly. Every year, the poorest households in America collectively spend tens of billions of dollars on lottery tickets, not the middle class, the people who statistically cannot absorb a $400 emergency expense. An economist looks at this and sees irrational behavior, mathematical insanity. The expected return on a lottery ticket is catastrophically negative, and these are the people who can least afford to absorb that loss. But that analysis misses everything that actually matters. For someone who feels permanently locked out of the wealth building machine, no inheritance, no connections, no capital, no runway, a lottery ticket is not a financial instrument. It's a purchase of hope. It's a $2 shot of dopamine in a system that offers almost no other legitimate path to escape. The decision makes complete sense when you understand the psychology behind it. Nobody makes financial decisions they genuinely believe are wrong. They make decisions that are logical, given the script they were handed. Understanding that is the beginning of actually understanding how money works. And honestly, this is the part of Housel's argument I find most underrated. Most financial writing starts from the assumption that bad decisions are a knowledge problem, that if people just understood expected value, they'd stop buying lottery tickets. But Housel is saying something more radical. It's not ignorance, it's context. The math isn't wrong. The emotional reality it ignores is. Beneath all of this runs an uncomfortable truth about luck and risk that we have built an entire cultural mythology to ignore. We worship Bill Gates. And we should. He is genuinely brilliant. But in 1968, he happened to attend one of the only schools in the country that had a computer terminal available for student use. That is a tail event, a coincidence so improbable it barely registers as plausible. His friend, Kent Evans, had the same intelligence, the same obsession, the same potential. He died in a mountaineering accident before he could graduate. Same raw material, different roulette outcome. We have a deeply embedded bias called fundamental attribution error. When we succeed, we credit our intelligence, our discipline, our work ethic. When we fail, we blame the circumstances. When others fail, we assume they were lazy or foolish, quietly erasing the invisible hand of risk that is always moving in the background, distributing outcomes in ways that have nothing to do with merit. This isn't pessimism, it's calibration. Acknowledging the role of luck doesn't diminish hard work. It just makes you honest about why some brilliant people end up rich and some end up forgotten. And it makes you a little less smug about your own wins. Let's talk about the trap that catches people after the wins. The one that has destroyed some of the most financially sophisticated minds in recent history and keeps destroying them because we never seem to actually learn from it. Sam Bankman-Fried was, by 2022, worth an estimated $26 billion. He was 30 years old. He ran FTX, one of the largest crypto exchanges on the planet. He advertised during the Super Bowl. Tom Brady was an ambassador. He testified before Congress as the responsible adult in the room, the one who was going to bring order to a chaotic industry. He wore cargo shorts to Senate hearings, and the press called it genius-level branding. And then, it all collapsed in about 72 hours. What came out afterward wasn't just financial mismanagement. It was something more psychologically revealing. Here was a person who already had more money than he could spend across several lifetimes, who allegedly took enormous and reckless risks with other people's funds, not because he needed to, but because the game wasn't finished. Because there was always a bigger number somewhere. Because in the world he inhabited, 26 billion made you feel like you were behind the people with 100 billion. He's now serving a 25-year prison sentence for fraud. And I want to be careful here, because what Housel identifies in his book is not that ambition is bad. It's that the failure to define enough is genuinely dangerous, not just financially, but psychologically. The goalposts don't just move, they sprint. And if you never plant them in the ground and say, this is it, this is sufficient, then every win becomes a new baseline, and the next risk becomes justified by the same logic that justified the last one. That is the never enough trap. And capitalism is extraordinarily good at generating it. We evolved in small tribes, wired to compare ourselves to the 30 or 40 people immediately around us. Now we live in a world where your reference point can be a tech founder on Instagram with a private jet, and your brain processes that the same way it would have processed a rival in your village, as a threat, as evidence that you haven't done enough. The writer Joseph Heller was once told by a mutual acquaintance that a hedge fund manager at a party had made more money that single day than Heller had earned from Catch 22 across his entire lifetime. Heller's response was simple: I have something he will never have. Enough. That word, enough, is one of the hardest to actually feel, because your expectations have a way of growing faster than your income, and when they do, you will feel poor, no matter how many zeros follow the number in your account. Here is where the real mechanics of wealth become genuinely counterintuitive. We associate wealth with action, with bold moves, with knowing when to buy, when to sell, when to pivot. We celebrate the decisive investor, the market timer, the person who saw it coming. But the first rule of compounding is this: never interrupt it unnecessarily. Warren Buffett has been investing since he was 11 years old. Roughly 97% of his net worth was accumulated after his 50th birthday, not because he suddenly got smarter at 50, because he didn't stop. The snowball just kept rolling, and he kept himself from knocking it over. Jesse Livermore made the equivalent of billions short-selling during the 1929 crash. He was celebrated as a genius. He believed it. He took bigger risks, convinced his judgment was infallible, and eventually lost everything. He died by suicide in a hotel cloakroom in 1940. Ronald Read, the janitor, did essentially nothing for decades. He bought stocks in companies he understood, didn't sell when markets fell, and let time do the work. His secret wasn't brilliance. It was restraint. It was the rare ability to resist the bias for action that our brains constantly generate. Getting rich and staying rich are not the same skill. Getting rich requires risk, optimism, and a willingness to look wrong for extended periods. Staying rich requires humility, a quiet fear of losing what you have, and the discipline to recognize that your winning streak is partly a function of luck. And luck is not a renewable resource you can just decide to keep. What I find genuinely uncomfortable about this is how completely it inverts the way we celebrate people. We build mythology around the bold move, the person who bet everything and won. But we almost never build mythology around the person who had the discipline to do nothing. Ronald Read isn't a hero story that goes viral. There's no Netflix documentary about a man who quietly didn't sell his index funds for 40 years. And yet, that boring, invisible, almost embarrassingly simple behavior produced more wealth than most professionals generate in a career. The story doesn't sell. The outcome absolutely does. There is a distinction that almost nobody makes, and it costs people enormously. Wealth is not what you see. It is precisely what you don't see. The person driving the expensive car, wearing the expensive watch, living in the expensive house, all you know about them is what they've spent. You don't know what they've saved. You don't know their debt. You don't know if they are genuinely wealthy or 1 month from financial crisis. Real wealth is the option value of money not yet spent. It's the investment account you never mention at dinner, the car you didn't buy, the vacation you scaled back. Wealth is invisible by nature, which means it is almost impossible to imitate, because we can only see each other's consumption, never each other's balance sheets. And this creates a deeply ironic trap. We spend money we don't have on things we don't need to signal status to people who are too busy doing the same thing to actually notice. Your savings rate matters more than your investment returns. And your savings rate is essentially the gap between your ego and your income. The moment you stop caring what other people think of your car, your watch, your address, no, that gap widens. And the gap is where wealth actually lives. The deepest implication of all of this is not financial. It is psychological. We live in the wealthiest era in recorded history, and we are plagued by anxiety, by the persistent low-grade feeling that we are behind, that we are not enough, that someone else is winning something we haven't figured out yet. The researchers who interviewed elderly people near the end of their lives did not find regret about market timing or portfolio allocation. They found regret about time, about presence, about the moments they traded for money that didn't ultimately matter. The real return on wealth, the one that doesn't show up in any spreadsheet, is autonomy. The ability to wake up and decide what your day looks like, to work with people you respect, to say no to situations that compromise your integrity, to not be desperate enough to make a bad deal. Savings are not just a number. They are a 6-month buffer between you and a decision you'll regret. They are the freedom to leave a bad job without panic. They are the difference between reacting and choosing. And yet, here is the problem with all of this advice, including everything you've just heard. We try to be rational, but rational is not always the right target. A perfectly rational financial plan assumes you will behave like a spreadsheet in the middle of a market crash when everything you've built is dropping in real time and your brain is screaming that this is different, that this time it won't recover. A plan you can actually follow is worth more than a perfect plan you'll abandon in the first crisis. History is not a map. It is a catalog of surprises. Nobody predicted that the September 11th attacks would lead to lower interest rates, which would fuel a housing bubble, which would collapse in 2008, which would send millions back to college, which would create a student debt crisis that is still unresolved. Cause and effect in complex systems do not behave like textbook diagrams. The lesson of history is not what will happen. It's how human beings behave when something unexpected does. Which brings us finally to the strangest risk of all. Think about who you were at 20 years old, the goals you had, the things you were certain you needed. Now think about the person reading this right now. Are those the same person? Of course not. And yet, we make 30-year financial decisions based on the assumption that the person we are today is the final version, that the dreams we have right now will be the dreams we have in 2045. Psychologists call this the end of history illusion, the consistent human error of believing that the self is now complete, that change is something that happened, not something that's still happening. So here's the question that actually keeps some people up at night. If the version of you that exists 20 years from now is essentially a stranger, someone with different fears, different desires, a different idea of what a good life looks like, then who exactly are you sacrificing for? And how certain are you that the stranger you're becoming will want what you're giving up so much to provide? Give that some thought.